Investors and traders, welcome to the channel Market Shock Brad. And today is 6th of February 2024. I hope everyone is having a great day. Apologies, the weekly video for the key US stock market indices and the markets that we look at. Something went wrong in the upload. I had to schedule it for release at a particular time, but unfortunately I don't know exactly what went wrong. It was not uploaded, so apologies for that. And because of that, we will actually also take a look at some of the longer term weekly charts in this video, and I'll try to keep the video short, but we'll try to cover some of the stuff that I wanted to take a look at with you guys in the weekend video. Uh, as always, this video is for educational purposes only and it's not a financial advice. So we will start by taking a look at our timing model that we have been following for quite some time now. And in that model, what we are looking at is a key date coming in on 27th of February 2024. As I mentioned, with time, we need to give it +2 days on either side, +2 or -2 to 3 trading days either side. So this is the key date that we are watching. My personal opinion is that the markets are actually likely to move higher till we reach this key timing, which is coming in by the end of this month. And then we have another key date coming in, which is on here around 2nd of April 2024. And what I think is we might actually put in some sort of a reasonable top in the markets, stock markets in the United States, around the end of February, early March. And then we have our key date coming in around beginning of April, and also what we have is our low to low cycle, the 54 trading days, which also comes around the same time frame. So perhaps some sort of market puts in a top around the end of February, and we could perhaps be even looking at some sort of a bottom to take place end of March, early April. And as we know, markets don't go in a straight line up, so this has been a pretty extended move. And look at this timing, 0.618 Fibonacci internal retracement. That is where the low was caught. Again, it's never going to be 100%. It could be, but it was pretty close. We have to give it +2 to 3 trading days minus or plus from these dates. So this is what we are watching in our timing cycle. With that, we'll start by taking a look at the bond markets. And with that, actually what I'll do is I'll take a look at the 2-year note first, and we'll take a look at the yield. So here we go. So this is the daily chart of the US government bonds 2-year duration, so shorter end of the curve. And here we can see that the market has actually been moving higher for a couple of days. So ever since basically the FOMC data came out, we have seen a bit of a resurgence in the yields, and that could be because of the talk that was given by the chairman Powell, Federal Reserve, where he mentioned basically he's going to be more data dependent, and whether markets expectations regarding whether an interest rate cut might come in March, it could be actually further away, the actual rate cuts. So that's why whenever we see data coming in with regards to inflation, where there is a hint that inflation could be actually stronger or the job numbers are stronger, we have seen a rise in yields. But it's good to see that today, 6th of February, we are seeing some pullback in this yields. And because of this, we also see volatility in the stock market come in as well. And the market was selling off from the morning, and towards the end of the day, end of the session, we saw buying come in. So that's why it's really important to watch what's happening in the bonds and notes. So this was the shorter end. With that, we'll take a look at the 30-year long bond futures. This is the daily chart. I am actually, yeah. So I will also take a look at the weekly chart for this as well. And what we can see is that past couple of trading days, the bonds really sold off, and we have this trend line created. This is where it has held today, which is good. It means that higher prices, lower yields, but again, a fair amount of volatility in this market as well, and it's a really, really big market. So now my personal belief, the story is going to be if the yields move lower, we're going to see stock markets or the risk assets move higher. And the key, really key number that we're looking for in this market is 118.28, which is 38.2% Fibonacci retracement. We did not hit it exactly, but we were close enough. Okay, and this is the weekly chart, and here what we see is basically the prices above the 20-week moving average, which is this blue line, but obviously it's been an extended bear market, so it's below the 200-week moving average, but it seems to be holding rather well around here, and the chances are that it's gonna go and actually touch these 128 level, which is 78.6% Fibonacci retracement, in 133 level is also possible, as long as this 118, 28, 29 level is not broken to the downside. So again, we're expecting some yields to pull back. With that, we'll take a look at the 10-year. This is the weekly chart of the 10-year Treasury note futures, similar kind of pattern. One of the things I want to point out is this concept of market symmetry. So every time the market had rallied by this much magnitude, we have seen a sell-off. Market is pretty much there, also around the 61% Fibonacci retracement. But over the course of a number of weeks, more than a month, the market is kind of in a sideways price action. The chances are it's actually going to go above and touch this 78.6% Fibonacci retracement, and even then target the 117 level. So this is what we are watching in this market. Let's take a look at the dollar index. So the dollar has actually been pretty strong, and one of the things is which we'll actually explore a little bit further in our U.S. stock indices. So one of the reasons the dollar could be strong is that because of the geopolitical situation, because of the war going on in Europe, in Ukraine, and things not being very stable in the Middle East as well. Perhaps there is a flight for capital to come into the US markets, and this is another reason we have seen some of the mega caps being pretty strong in the US markets. And to buy the assets which are denominated in dollars, you need the dollars. So it's one reason perhaps that the dollar has also been pretty strong. From a technical perspective, this is what we are watching. We were looking for the market to pull back right into 78.6% Fibonacci retracement, perhaps a little bit lower where this box is. This is exactly where the market went, and now it has retraced about 50%. It's between 50% and 61.8% Fibonacci retracement. The chances are that in fact the dollar could actually get even more strong, and could in fact try this one-to-one price projection ABCD pattern around 108 level, where we also have the 1.272 Fibonacci expansion. And of course, if this 100 or 99 level is broken to the downside, we're looking at a very different pattern, and we'll be looking for a much weaker US dollar. But right now the dollar is pretty stable, and the chances are it is actually going to get stronger. With that, let's take a look at the Euro USD. So Euro dollar, Euro USD is gonna be a bit of a mirror image, but not exactly, because it's about 51% of dollar index composition is actually euro. So here it could actually pull back to around 104 level on the weekly chart, as long as this 78.6% retracement is held. So because that's our point C, so A, B, C, D, and we could in fact go much lower. However, on the daily chart, we have a number of things happening on the daily chart, where we have some support come in. So we have this double bottom around here, the 61.8% Fibonacci retracement around here, and we have a number of these smaller ABCDs which have not drawn are coming around here as well. So we could see on the daily charts, perhaps the euro actually strengthened against the dollar, and some shorter term weakness come into our dollar as well. And the markets could actually in fact rally, maybe one big figures, so around 108 30 level thereabouts, where we have these moving averages, maybe even to as much as the 38.2% Fibonacci retracement of this entire move. So actually let me draw that for you. Okay, here we go. So yeah, whereabouts this 20-day moving average is around 108.70, 108.30, 108.70. That's the level where this market would in fact rise to before we get a pretty strong resistance come in. The other really interesting market is the USD Japanese yen. So the Japanese yen has been the dollar has been very strong against the yen ever since finding support from 78.6% Fibonacci retracement. And we were looking for this market to head to a 149.30 level, which is 78.6% Fibonacci retracement. It's still possible it could get there, but we have seen some weakness coming into in this market for the dollar. And in euro, we have also seen some buying or some selling for the dollar versus the euro has come in. So maybe it just goes sideways a little bit, but looks the chances are it's actually heading for the 78.6% Fibonacci retracement. Momentum also remains pretty strong. With that, we'll take a look at the gold market. So gold, um, I will actually move to, let me try taking a look at the weekly chart for gold. So this is the weekly chart of COMEX gold. So this is futures, it's not the spot market. So what is really amazing about the gold market is this is something which we have mentioned or talked about previous videos as well. Given how strong the dollar is, this market is pretty resilient. It's not breaking down. We are not seeing $34 moves, $64 moves, $100 moves in this market. Um, sure, there is volatility around when the key numbers are reported, such as the jobs data, for example. But it's holding rather well, in my opinion. So, what are the chances? I think on a weekly chart we need more clarity, but look at these how sideways this market is. But if it is able to get above 2090 or even 2100, then the chances are that in fact it might be doing an ABCD to the upside, where we can see this market move much higher. So this is what we are looking at in the gold market. So now let's move to the uh, stock indices. So this is the weekly chart of the S&P 500, and the S&P 500 is the cash market. This is not the futures chart. Here, one thing I really want to point out is that look how well established this trend line is um, for this market, going back to the lows of March 2020, the COVID lows, and it's just one touch, two touch, three touch. It's really strong. So that tells you there is a fair amount of strength in the market. Now, shorter term, we were looking for on the weekly chart 49.18, 49.20. The market is actually much stronger. The week has just started. Today's second trading day. Here we have now a higher target as well, which is around 51.88, which is the 1.272 expansion. This is the shorter term target. On the upper side or the upside, that will be looking for this market, because this ABCD pattern that we see, the market is much stronger for that. So the chances are actually this market is moving higher, which is also it tallies well into the timing model that we have been watching for. And on the daily chart, we can see that the market is above this 49.10 level that we had been watching, this ABCD pattern formation. So the markets do look stronger, pretty strong actually. So now let's take a look at the ES. So this is the daily chart of ES, and I'll actually move to the weekly chart. So here we go. This is the weekly chart for the ES, and much like the S&P 500 cash index, 5144 is where the market would actually be also moving. So the weekly charts are actually pretty bullish for these stock indices, with the exception of Russell 2000, which is a little bit mixed. We'll take a look at that, but it's also improving. Now we'll take a look at the NASDAQ 100. Here we go. And just waiting for the chart to load. Okay, so here we go. Shorter term, this is 18,570 that has we have been watching for. Looks like the market actually might try to target this, but this market compared to S&P 500 has come under a bit of pressure, which is expected because of the tech stocks, with interest rates being higher. These are high growth stocks, and interest rates have an impact on these kind of stocks. So a bit of a sideways action, but looking at these weekly charts, we don't really see any reversal pattern. No negative candle closing for the week, so it looks pretty strong. And because of this, the target shorter term, uh, the 1.272 expansion of this BC leg, 18,570 looks like is achievable. Now we will take a look at the Dow Jones. Oops, this is not Dow Jones. Okay, so this is the weekly chart of Dow Jones Industrial. And here we had this ABCD pattern completed in this market much before the other markets, in other words, caught up to it. But this has been pretty strong, and it's actually, the weekly close for the last week was much higher than this level. So it's really good. This is something which we mentioned that it is improving. So that's good. The Dow Jones is actually an index which is not market cap weighted. It is price weighted, which means that the stocks which have a higher price, the movement in the in the price of those stocks impact this index quite a lot. But it's also an index for which we have the most amount of historical data available. So to do the analysis is really good. At the timing side of things, they work in these index really well, and that's why it's important to look at Dow Jones. Only 30 stocks, but really big mega caps exist into this. So here, one of the things that I wanted to show you was, so this is what we are seeing it, the Dow Jones Industrial making new highs in the USD. And if we just change that to euro, and what do we see? Just waiting for this to load. We see Dow Jones making new highs in euros currency as well. And then if we do GBP, this is the Great British Pound. What do we see? We see the Dow Jones Industrial making new highs in the Great British Pound as well. And finally, the other major currency we'll take a look is Japanese yen. And what do we see? This index also making on new highs for Japanese yen as well. So what does it tell us? It tells us that there is a movement of capital into the U.S. stock market and some of these mega caps which are part of the Dow Jones Industrial Complex. So it's another reason to believe that actually the markets could actually, in fact, there's a good chance, moving higher. And some of the key levels that we have identified in the key markets, those might actually be achievable. The timing model that we are looking at will be paying really close attention to those dates as well. Last but not least, let's take a look at Russell 2000. So this is daily chart of Russell 2000. On the daily chart, this chart is improving in my opinion, although there's fair amount of resistance coming from the 38.2% Fibonacci retracement. But on the downside, it has kind of stopped at the, I think it's the 78.6% Fibonacci retracement. And let's quickly take a look at this. Yep, it is. And because of that, it's pretty good news that this market actually, if you look at it, this market was pretty strong today. Again, an inside bar on the weekly chart. Here we go. All it did was try to break out of the range, back into the range. 38.2% Fibonacci retracement from this low to this high is proving to provide good amount of support. And the thing about 38.2% Fibonacci retracement is strong trending markets. It's a pretty good support or resistance level depending upon which direction the market is actually moving in. So here it could in fact be a pretty good support level. And also the momentum is improving, it's taking its time. And if we just look at this market over a long period of time, that's a couple of years, um, nearly a couple of years, we see just a really sideways range bound market, really not a very fantastic market to take a look at. If we compare it to S&P 500, for example, which has made new all-time highs. Again, these small caps are pretty sensitive to interest rate movement, so it's understandable. And it's just retraced 50% from this low to this high, and then the upper boundary of this range is also been 50%. So between the two 50%, it's just been in a trading range for a very long time. Rather unusual, but also these are unusual times as well. With that, I would like to take a leave from you guys. Apologies, the video has been a little bit longer, but again, we had to cover a fair amount of stuff because the weekend video was not uploaded because of some technical issues. Apologies for that again. So thank you very much for watching the video. Good luck and good trading. Just really quickly, I just thought of it. While we are here, let's actually take a look at the Tesla stock. Here we go. Daily chart of Tesla pulled right into that 175 region that we were watching for. Today has been a bullish day. In fact, the price, it's been an outside day because this bar closed above the highs of the previous day. So good price action. Now we'll be watching for a follow through, and if we are able to get a follow through and the price begins to close for 2 consecutive days above our key level, then the chances really increase that perhaps we might have seen a pretty good low in this market, in my opinion. And from a timing perspective, around 23rd of Feb is another timing coming in for which works for this particular stock. It's different to the timing for the overall market that we are looking for in the Dow Jones. So again, this is what we are looking for in Tesla as well. So thank you very much for watching the video. Good luck and good trading, and speak to you guys soon.